You're talking about a serious trade war. You're talking about several hundred billion of tariffs from the U.S. And I think that China at that point obviously would have to retaliate with, as it said, both quantitative and qualitative measures, because it doesn't import as much from the U.S. to match that 200 billion. I think for the economy, the initial stages, I don't expect actually this trade war to have a huge macro effect in the short term on the Chinese economy. This is the biggest macro story of the year, but I think we're really going to see it play out in a microeconomic way. But the macro piece shouldn't be too impactful on China's overall pace of growth. So in the short term, I'd see a reaction in equities markets, for example, continued fall off in Chinese equities. In the longer term, if the trade war persists, then we're looking at a sort of a recalibration of global supply chains. Well, this is where foreign companies, I think, are most concerned, rightfully so, is what are the qualitative measures? And I think the AmCham in particular, even top leadership has been pretty clear that American companies are going to be a casualty of this. And that's, I think it starts with disrupting or delaying imports at customs. So that's, not a quantitative disruption, but a qualitative disruption. And then it's things like more inspections, fines, approvals for licenses will be delayed, dawn raids, all of the things that we've seen China been doing to the MNC community in the past. And in particular, they sort of laid out this playbook with South Korea in 2016 and 2017 during the THAAD dispute. They're already starting to play the nationalism card right here, and so they're already building that narrative if they need to use it. I think Chinese consumers will very quickly change tastes. I think the tourism piece in particular is a very easy one to change your purchases, right? It's hard to, change who you buy soybeans from, but it's not hard to change your ticket to Europe instead of the US. And that's one I think that's overlooked, because actually travel services is the biggest import that China has from the US. It's bigger than agriculture, which is about 16 billion US a year. Travel services are about 40 billion a year. So that can hurt American leisure or hospitality companies. America's so big that I don't think you can do it to the same sort of comprehensive effect that you could do it with South Korea, but you can do it enough to hurt. Well, I think on the investment side, that's the real piece that will challenge long-term growth in China. Its ability to continue to move up the value chain, because a lot of the way that it's gotten technology is by investing in other companies. And, that's IP transfer, illegal IP transfer is not a legitimate way to influence foreign companies, but acquiring another company is totally in bounds. And so if they can't do that acquiring because of geopolitical or political issues, that's going to challenge their long-term ability to move up the value chain. In the shorter term, again, I think the trade war will drive up prices, so maybe you have a bit more inflation. I think the central bank is not worried enough about the potential inflationary side. But global growth in trade is still pretty strong, so they're still exporting well to other parts of the world. And exports to the U.S. are 17% of China's overall exports, so it's a big chunk, but it's it's not 100%. So it would be a dent to growth if Americans start buy less Chinese goods, but I just don't see it as having an appreciable effect on the overall macroeconomic growth rate. I don't think so, and I think it's because that's cutting off your nose to spite your face. I mean, all of the trade war is an exercise in self-flagellation, inflicting pain on yourself, inflicting pain on the other, but having collateral pain inflicted on yourself by doing so. But the Treasury issue just totally depletes the the value potentially of China's own FX reserves. So they'd be, if they sell off treasuries, they hurt their own FX stockpile, and to me, it's not clear to me that that would even be an effective tool, because the Fed can just buy those up. If they sell them and the Fed buys them, there's net no change in the global ownership of U.S. Treasuries. So it's something that could potentially hurt them. Two, it may not have an effect at all, so it's a potentially ineffective policy. So why even go down that road? I think the PBOC is too level-headed to try that route.